Roger, I want to expand on something that you said. Um, you had mentioned earlier that AI could very easily take the place of a lot of us out here. I don't know if any of you work with GruntWorks, GruntWorks, but GruntWorks for the last 7 or 8 years has actually had the ability to do a tax return just by scanning in the documents, and it will come back and preload on your tax package, your tax forms. Other than you just looking at it and signing it, you don't have to do a thing. Now, this is for a basic tax return. Again, if you have expenses, if you have itemized deductions, you could actually scan in 1098s from the mortgage company. You could scan in contribution forms from your different charities, and it can handle those. So it already exists. I think the thing that differentiates us, though, and makes us different is the same thing that makes the medical community different also. Even though a lot of the surgical procedures have now gone to AI, and in fact, you can see this changing every day. The doctors still supervise to make sure that everything's running smoothly, but we're seeing more and more of the medical community. If you've got an ailment, you can go on today and ask AI, these are my conditions, or this is what I think is going wrong with me. Tell me, am I just imagining something, or could I have a condition? And AI would be able to analyze that for you. Comes back to the same thing in our profession. In our profession, people will always want accountability. For years, we've seen people with TurboTax, and we saw a lot of our clients go to TurboTax. But who usually goes to TurboTax? People with simple returns, people that don't have any reason to think that they can't just go out and run their credit card with TurboTax and boom, they're done. But who's doing all the input right now at TurboTax? The payer is. Okay? And what if TurboTax goes wrong? What if they get a letter from the IRS? Guess who's going to scurry back to see us? Well, where you been for the last 3 years, Joe? Oh, I've been using TurboTax. Well, talk to the box. No, I mean, you've heard the joke. Talk to the box. But again, being serious, people want accountability with their tax return, and it's kind of hard to hold the box accountable. He used to call the TurboTax in the box. It's kind of hard to hold TurboTax responsible. And they also like, as Roger was saying, they like the fact that we will strategize with them. We will talk to them about ways that they can make more money and pay less tax. And when they've got a problem, I don't know about you, but I get emails constantly during the year. Ben, I started a new job. Help me fill out my W-4 form. I think for that reason, they're calling our service now the soft side of taxes. The hard side of taxes, yes, AI can handle that for the most part. But the soft side of taxes, people will always want to come have somebody else, first of all, take the responsibility or the accountability for what gets filed. And secondly, they're going to want to know about strategies. I mean, how many clients do you have? Yeah, I was talking to my neighbor, and he's talking about such and such, and he's getting all kinds of money back. Tell me how I do that, Ben. Well, many times we will go ahead and look to what's going on and find out that, yeah, that's a great idea, but you got to have more money to put into it. Or, wow, I hope you don't get too close to your neighbor because, you might have IRS agents pulling up in his driveway in one of these days. Um, again, we can be that signpost. We can be the source that they can always come to feel like, yeah, I'm doing good, or no, I'm out on thin ice. You know, Roger was talking earlier about the lake being frozen, and immediately I'm thinking Ice Road Truckers. How many of you watch Ice Road Truckers? Okay, all right, probably not too many. It's a guy thing. But now going back, let's go ahead and take a look at that slide, Jim. And okay, 2025 tax update. I've still got the flash drive if you need it. Okay. Well, I tell you what, while Jam's working on that, let me just give you a quick overview. All right. You've been hearing about this now since July. The One Big Beautiful Bill Act. Now, we could give it a name or an acronym and call it OBA, but I heard another acronym used recently that I liked, and I thought, well, let's consider this one too. How about OB3? Or I could just say the Big Beautiful Bill. Um, so you're going to hear me use one of these three acronyms, or you're going to hear me say, let's not get too confusing here, Rich. But I like your idea. Thank you. All right. So what are we going to talk about today? Well, again, you're going to see that I'm actually teaching on this same topic over the next 3 days. So I'm teaching today. Are we good? Almost? Okay. Um, so I'll be teaching on this over the next 3 days. That's just the way the schedule worked out. I didn't deliberately set it up this way, but I can be the one that can be flexible. I figure what I'm going to do right now is get into most of the big changes. Okay, there it is. And you can go to the next screen. And yeah, oh, let's get him off of there. Okay. All right, learning objectives. So we're going to spend time talking about these changes for 2025. What changes in 2025 for OB3? And then what gets pushed into 2026 or into 2027? And we're going to spend that time right now talking about that. Also, you'll notice in your printed material here that everybody should have that there's a comparison in the tax tables between 2024 and 2025. Well, Ben, that's great. Why do we have that? How many of you have clients that come in? Ben, what tax bracket am I in this year? Well, I need to see your W-2s first. It's kind of hard for me to, you know, uh, pick that up with ESP or anything. So that's the reason I set them up there. So if clients want to see the difference between the tax brackets, they can see it and you can show it to them. I'm going to bring up a lot of facts on other things that impact your taxpayer this year. And again, most of those are going to be pushed into day 2 or day 3. But let's talk about the energy side first. It seems like the energy side got hit pretty hard this year. We already know that for electric vehicles, if you didn't buy one before September the 30th, you're not going to get the credit. So, that's probably one of the biggest ones to hit. Um, sorry, you can change the, there we go. All right, so let's go. First of all, we still have the 30% energy credits out there for wind, solar, geothermal, biomass, trash and landfill gases, hydropower, marine, and hydrokinetic resources. So this is stuff that's actually, the ocean is actually generating electricity. Well, we know that their windmills haven't worked out too good for the whales. So, but these are still in effect through the end of this year. But after December 31st, these 30% credits for, yes, solar. How many of you get calls from time to time? Hey, we got this great program. We want to put we want to put solar panels on your roof, and somebody else is paying for it. Sure they are, you know. Um, but it's like anything else. There's people out there that want to sell you just about anything. But if you don't do that solar, if you did decide to put solar panels up, you got to do it before the end of this year. Otherwise, the credit has gone. Credit, it expires on December 31st of this year. All right. We also have the non-business energy credits for people's homes. Tankless water heaters, biomass stoves. Those are the ones that have up to a $2,000 credit. What about the $1,200 credit on Form 5695 that picks up the credits for insulation, storm windows, storm doors? I'm sorry? All that goes away the end of this year. So folks, if you got people that you knew were going to put these kind of changes in their house, they come in next February or March. Ben, I was thinking about adding this to my house. Well, it's a good idea, but there's no longer going to be a government credit for it. It all evaporates as of December 31st. So this is the $600 for energy efficient windows, doors, and then the $500 credit for so many other things. Also, the insulation that you would put into maybe your attic or into your walls, the high efficiency HVAC systems with a SEER rating of 20 or 21 or above. The home energy audits for $150. All these things go away at the end of this year. So be aware that if you have clients that come in next year and they're talking about energy credits, unless they put them in 2025, folks, that train's gone and they weren't on it. Okay. You want to pull that back up? Let's see. Back up one screen. Yeah. Let's pull this up for just a second. Now, your 30% alternative fuel refueling property credit. Let's say that you have a CNG refueling center that's going in. Those people can still get the credit up to June 30th of 2026. So again, all this information's in your printout as well as on the slides. Commercial buildings that qualify for the new energy credit, they do not expire until June 30th of 2026. The clean hydrogen production credit, I don't know of anybody that's got anything like that going, but they have to get that production facility up and running before January 1st of 2028. So that if it's before January 1st of 2028, then that means that it expires on December 31st of 2027. So, if you got anybody into the clean hydrogen side, also clean electricity production and investment credit. If you're into big solar farms, now this is the big projects, not the individual home credit. But if you're into big projects, you must start the construction before July 4th of 2026, and it's got to be in service by the end of 2027. So be aware of the fact if you got people that are investing in big solar projects, they've got a short time window. The clean fuel production credit. You know, this is the one that always was interesting to me. This is the one that talks about a recycling used vegetable oil. You know, you got maybe a fried chicken place that uses that oil and they use it all they can. Well, that's still going to be available. If you want to put this in, if you have a vehicle that will run on this used vegetable oil, or also gets into different grease and animal fat, anywhere in the USA, Canada, or Mexico, the credit begins again. Now, remember, this credit used to be out there. Evidently, we lost it a year or two ago. It begins on January 1st of 2026, and it runs through the end of 2029. So if you're recycling stuff from restaurants, basically it would be from a restaurant, and you can recycle it, filter it, put it back out as fuel for some kind of a alternative use vehicle, that credit's still available for you. All right, I'm ready for the next slide. So, okay, here's the big thing you've been waiting for. Tip income, overtime pay. Both of these are, again, for tip income, limits it to $25,000 a year in tips if your MAGI is not more than 150,000 for single head of household or 300,000 for married filing joint. So understand that there is an income threshold that we have to worry about. So if you have somebody coming in with tip income and they're, let's say you have one that makes a lot of tip income and then they have a spouse that's bringing down $400,000 a year. Well, guess what's going to happen? Ben, but they said I wouldn't have to pay tax on my tip income. Well, you know what? I can't help that. Your income is too much. Well, mine is an income. I said, well, you know, goes back to what Roger was saying. Well, maybe divorce your spouse and then next year each of you filed as two single people. You can still live together. No, of course that's ridiculous, and I'm not. Please understand, I'm being facetious right now. I'm not asking people to go out and get divorced so they can get a tax break. Not that I don't have some clients that might not take that advice. You know, might have some women. I was looking at getting rid of that old rascal anyway. So, but at any rate, be aware of the fact that there is an income threshold, an income limitation for the tip income. All right, overtime pay. Now, this is all going to show up on the 2025 tax return. These people that qualify for these breaks are going to be amazed at the refunds they get this year. We are going to be the good fairy again with a little magic wand. The tutu is optional. Okay. Yeah, but you're going to feel like the good fairy, the tooth fairy again. You know, you just, and you get a refund, and you get a refund, and you get a refund. So be aware of the fact that you're going to see situations where these folks that qualify for no tax on tips, people that have no tax on overtime. Again, overtime, same thing, goes up to a maximum of $25,000 a year for married filing joint. However, it's limited to $12,500 for single or head of household. So, do I need another slide up, or am I still there? Yep, I'm still there. Good. Okay. Do what, Bobby? The employer is going to have to break that out for you on the W-2 form. Now, we haven't seen the draft yet of the W-2, but believe me, it's going to change this year. And it's going to have a spot somewhere. We're going to have a code or a spot or something that tells us how much of their income was for overtime. Now, you know, going back just one item here. For tip income, I don't know if any of you have pulled up the package on tip income yet, but it's about that thick, and it gives you about 400 or 500 different occupations and gives you a code number. So guess what you're going to have to do? When your client comes in, you're going to have to determine which code number shows up for their tip income. And I'm sure the tax programs are probably going to have a search menu. Hopefully they will, where you can go in and search, bartender. And you look up bartender under the search and it's going to come out and give you the code. But you have to use a code to justify the tip income deduction. So be aware that these codes are necessary, and your tax program is not going to let you send that thing electronically until you get a code under what type of tip income this is. Okay? So, unfortunately, or fortunately, I should say, for overtime pay, there is no code. It's just overtime pay. You got paid overtime, here's the amount. You're going to be able to exclude, if you're married filing joint, you're going to be able to exclude $25,000 a year for married filing joint, or $12,500 for single head household. Again, same income threshold, 150 is where it starts to taper off on the overtime pay, or 300,000 for married filing joint. Okay, then Roger already talked quite a bit about the seniors. Again, the seniors are going to get, once you're age 65 or older, if you're receiving, and you have a social security number. So this is only going to work for U.S. citizens. If they have an ITIN number and they're 65, guess what? Sorry, we don't have anything that we can put down for you. But if they're seniors, and here's the tough part. This is why what Roger was saying earlier is so important. You need to have tools on your tool belt to reduce their AGI. Why? Because for the seniors over 65, if you're married, filing joint, and you make more than $150,000, you reach the threshold for getting this $6,000 break. And if you're single and you made more than $75,000 in AGI, reach the threshold. So what Roger's talking about, all the session he talked about today, is going to be critical. We're going to need to find a way, and we're doing this usually after the fact, which is going to be difficult in some cases. There may be a couple of tricks that we can pull off, but not too many. Again, some of the retirement accounts allow us to go to April 15th of the following year to put in a contribution for a SEP, or for an IRA. And if you got an extension filed, how far can you stretch out a SEP contribution? Till October the 15th. So you may still have a few options open, but there are so many things that your clients need to know about this. So if they think they're going to come in and they're going to have all these magical deductions, it would be nice if you had a way of at least giving them a heads up. Well, Jerry, you and your wife made $500,000 last year. You're not going to qualify for any of this stuff. Or Sally, I know you're a single mom, but you're making great money. You're making $150,000, $160,000 a year. I'm sorry, but you don't qualify for it. It's in a phase out. Be aware of the fact that these income limitations are going to greatly impact things that people think they're going to get. I already know this is coming. I'm going to have a lot of seniors come in this year, and they're going to say, Ben, President Trump said no tax on Social Security. Can I guarantee that? No. Why? Because there's only a $6,000 deduction that's going to get added to your standard deduction. $6,000 per. So if you got both of you are over 65 on a married filing joint, You each get $6,000, so you can get 12 total. But what if they make more than 300? Sorry, what if they make more than $150,000 married, filing joint? You're on a phase out. I mean, you get something, but it's going to phase out fast. And we haven't seen the charts yet. Understand that the government's closed right now, so a lot of this stuff that would be written up in regulations or updates or FAQs, frequently asked questions, it's not available right now because, you know, um, if you're familiar with Keebler, the little elves are not up in the tree anymore. So, okay. Probably not. Okay. Um, okay, that's a good place. All right. Again, passenger vehicles, as we already said. Um, oh, I'm sorry. Passenger vehicle loan interest. Here we go. Brand new. We got a new toy to play with. If they buy a U.S. vehicle, a vehicle made in the U.S. Now, again, not going to help you unless the BMW was produced somewhere in a factory inside the United States. If they buy a Maserati, that's probably not, I don't know of any Maserati factories in the U.S., so that's not going to help them. But when they finance that vehicle, they're going to be able to take off up to $10,000 in interest for the loan that they take out on that passenger vehicle. Like I said, has to be produced in the U.S. and this will run from 2025 through 2028. You don't have to itemize. So this is going to be another one of these items that gets added to the standard deduction. Just well, I think that's a good point. I think it's got to be new because you have to list the VIN number that basically establishes that it's a new vehicle. So I'm afraid it is a new vehicle. The last thing I remember reading on this. Um, all right, child care. So child care, the good thing about child care is, folks, for people in the lower income brackets with children, child care credit is going through the ceiling. It now can be up to 50% of what they pay for child care. So understand, if they pay, well, again, unfortunately, child care is going to be limited to $6,000 for two children, up to two children, but they could theoretically get $3,000 back if they had two kids maxed out to $6,000. So understand, your program is either going to be very generous depending on income levels. If they make a little more money, yeah, they'll be back at the 20% deduction for child care. But even 20%. So you now operate between 20 and 50% on child care. So be aware, those are changes. Now also, you've got the child tax credit, which goes to $2,200 this year. Well, Ben, that's only a 10% increase. Well, if you got three kids, that's an extra $600 in refund, isn't it? So, no, it's not a big deal, but it's something more. And I tell you what, some of these single parents, some of these parents that are both working and struggling to make it, they're going to be happy to have $2,200 a child. So be aware that's going to be an increase. And after 2025, that credit is going to be adjusted for inflation. So if we had, now again, we see inflation going down. I think we got 2.8% increase for seniors on their Social Security this year. So if we're looking at 2.8 or 3.0, it's not going to be a big change, but 2,200 times 3%, hey, take what you can get. So in 2026, this $2,200 child tax credit is going to be adjusted for inflation. Okay. All right, we got salt. Let's talk about the salt credit. All right, here's the interesting thing. Salt credit goes up to $40,000 this year, 2025. So you're going to have a lot of people that up to this point, well, Ben, you told me I didn't even need to worry about itemizing. Well, you know what? You're making $500,000 this year. Your salt tax might be at the maximum of 40,000. Could be. Probably is. So will 40,000 usually blow the standard deduction out of the water? Thank you. Probably will. So all of a sudden, well, Ben, I only got like $4,000 worth of mortgage interest. Well, bring it in because we could use it this year. Well, and yeah, we only give about $1,200 to the church. Bring it in. We need it this year. So you know your high dollar tax clients will need to be pampered a little bit. If you send out a newsletter, you might want to tell them, bring in the expenses for itemized deductions this year because you might qualify. Now, that's not going to be for your lower clients, but for your upper clients that are probably going to be able to utilize this $40,000 worth of salt tax, that's going to be a big change for them. All of a sudden, now they can itemize. Well, think about one other thing. If you have maybe a 10% increase in people that can itemize this year, what else does that bring back in 2026? State refunds may be taxable again. You know, we thought that was gone. We said, well, nobody itemizes anymore. Or if they do, they lose, you know, it gets lost in the excess above 10,000. Well, guess what? If they can now use these larger amounts, you're going to have to start thinking, yeah, now, if you get your program to save that information, then you can have it carry over automatically. How many of you use a program that carries that state refund when it is taxable? Yeah. So it's not like something that we have to do, but you might have clients again asking you, hey, why am I having to pay tax on my state refund? That's not right. And you know, you and I have been through this so many times. You got to take the time and explain to them why they have to pay tax on that state refund. Because you took it as a deduction last year, it helped give you, it goes back to the tax benefit rule. You got a tax benefit for it last year, therefore, you got to pay tax on it this year. So be aware that that's happening. All right, we got about, what time do we end today? About 20 minutes from now? 4:50. Okay. So, all right, Roger's already explained to you. After January the 20th of this year, any equipment that's depreciable, that gets capitalized, now goes back to 100% bonus depreciation. Roger's already hit on that pretty well, so I don't need to hit on it any further. Okay. Oh, one thing I need to go. Let me slip back to salt real quick. Guess what? Every one of these deductions seems to have an income threshold. The income threshold for salt is 500,000. Now that's a nice kick up, but if they go above 500,000, guess what? They're going to start phasing out their salt deduction, but they can't drop below 10,000. So if you had somebody that came in with $1 million, they'd still go getting the $10,000 salt deduction. It's just because they're over 500,000, it phases out for them. Okay. Again, we all remember the 100% bonus depreciation. Anything with a class life of 20 years or less is usually going to qualify. All right. One big change. 1099K. Let's see, do I have that up there? Yep, 1099K. 1099K has gone back. You know, we had this back and forth and back and forth. Well, $2,000 or 200 transactions versus $600. And we thought we were going to be stuck with the $600 as being the, the, the one time that a statement comes into the taxpayer, hey, you got over $600 from this credit card company. So we're reporting it to the IRS on a 1099-K, live with it. Well, guess what? It's now gone back. We're back at $20,000 or 200 transactions. So if you got somebody that's selling stuff on eBay, yeah. Now, if they're selling, let's say that somebody has a relative die and they go in and they start selling stuff that they inherited from that deceased relative and they sell it on eBay. Is that taxable? No. I was just doing that for special effects for the people out there. It's not. So be aware of the fact that if you're selling your own stuff and you're using eBay, it's never a taxable scenario. Even if you get a 1099-K, what I would do is I'd put 1099-K on Schedule C, go to the next line, line 2, and exempt it back out. Sale of personal inherited property, non-taxable. The reason I put it in on Schedule C, why? Because 2 years from now, that client's probably going to get a CP 2000 letter saying, you never reported this income. I find it's better to put it down and exempt it out. And if they want to audit my client, sure, come on. I'll show you. They inherited this house and everything that was in it. It was their personal stuff. They didn't run a business. All they're doing is getting rid of stuff that came from Great Aunt Alice or Uncle Willie or whoever. And so just be aware of that fact that just because they get a 1099-K, it doesn't always mean it's taxable. Okay? Now, if they're going out and they're buying stuff at flea markets and yard sales and bringing it in and selling it, is that a business now? Yes, it is. What if they only make $300? Hey, it's a business. If it's ongoing, meaning more than 2 years, if it's ongoing, you got to count that income. Even if not, you could consider it a hobby. And what happens with hobby income? It gets added to the front of the 1040. It's not subject to SC tax, but do you get to write off the expenses of the hobby? Not anymore. Not since 2018. So be aware of the fact that even if they're only making $300 from eBay, if they've turned it into a business, well, Ben, I bought all this inventory. Can't I write it off? Not until you sell it. They love that answer, don't they? But I got $1,800 worth of inventory. Well, when you sell it, let me know and we'll deduct it. But I get to write it off. No, you don't. I wish you did, but I can't change the law. So, it's tough when we have to tell them. Inventory is not deductible until when? When you sell the item. So that's when inventory. Otherwise, what would everybody do that was in business? If you're in a retail business, you'd be out there stocking up your inventory on December every year. Why? Bring your income back down. Well, I know how to offset all my income. I'll just go buy inventory. That's why the IRS changed the law on that, or they got Congress to. They said, you can't write off inventory until you sell the item. That's why we keep track of their ending inventory on the end of December, first 10 days of January. We got to have that inventory figure in there so we know it does get deducted, right? Everybody with me on that? But remember, if they want to treat it as hobby income, it still gets reported on the 1040 line 8, line 8Z. 8Z, you put in the amount, hobby income, $300. Well, Ben, how about my expenses? It's a hobby. Hobby doesn't get to write off expenses. You sure you don't want to count this as a business? Well, maybe that would, yeah. Put it on Schedule C, but now you're subject to what? SE tax, unless it's below what amount? $400. If it's less than $400, they don't get hit with SE tax. So if it's small that may be the wise decision. Move them over to Schedule C, and you're a whole lot better off. Okay, QBID. Who remembers what that stands for? Qualified Business Income Deduction. Roger spent a lot of time teaching us about this through the years. If you were paying attention, it's a great break. Now, if they make too much money, again, you go back to some of the ideas that Roger shares on conservation easements, on buying oil and gas partnerships that show you as a general member the first year and allows you to deduct up to 85% of what you invested, and you try to bring that income back down so that you can get below the 300 and, did I actually put it here? I didn't put the actual amount, but it's up just short of $400,000 if you're not a service, if you are a service industry. If you're not a service industry, your phase out is now 150,000, but you have a reduction that brings in 50% of W-2s paid or 25% of your depreciable assets at purchase price, not at current value, but at purchase price. So if you paid $100,000 for an asset, and even though you've depreciated it halfway down, when you do this for QBID, it would bring you back to using the $100,000 you originally paid for it and pull 25% of that, or half of the W-2, or there's a combination of the two, and I let my computer usually do that for me. Roger, you probably remember how that works for QBID. Welcome to jump in at any point. Okay. Am I coming through loud and clear, Jim? Okay, good. All right, let's go to the next slide. Estate and gift tax exemption. Boy, that rascal's getting really close to $14 million, isn't it? $13,990,000 for 2025. In 2026, it's going to 15 million. Actually did even out at an even 15 million after playing with a lot of these squirrely figures from year to year. So, and I'm going to share this later, but what's your annual giving amount for an individual before you're subject to 709 gift tax? It's actually 19,000 starting in 2026. So just be aware of that fact. That's gone up. Now, in 2026, how's our time? Yep, we still got it. In 2026, be aware of the fact that mortgage interest is going to all be capped at 750. You know, we've been able to take this exemption that if you were in there before, was it 2018, that you could have $1 million mortgage and take the exemption because it was 2008 before 2018. Now they're bringing them all back to under. Now this begins in 2026. You still can take the $1 million exemption for 2025, but starting in 2026, the mortgage cap on all mortgages will be back at 750,000. Now, there's also a situation where mortgage insurance premium is going to come back. You can go ahead and fill up that whole screen, Jim, if you would, with the slide. Okay. Mortgage insurance premiums coming back, but there are several restrictions on it in 2026. There'll be a phase out provision for any married filing joint return over 100,000 or any single return over 50,000 AGI. Well, if your threshold is that low, are you usually going to be itemizing anyway? So I think they did it as an exercise for us. I think we're probably going to have 0.0001% of our clients that actually qualify for taking mortgage insurance premiums. But hey, at least it's there so that they can tout a little bit and say, look what we've done for you. Yeah. Okay. Um, Also, beginning in 2026, charitable contributions are going to be deductible up to $1,000 per taxpayer, 1,000 for single head of household, or 2,000 for married filing jointly, without having to itemize. We've seen this come around from time to time. It's back in again, and it's going to be there so that you can, even though you're taking standard deduction, you'll be able to each take up to $1,000 in charitable contributions that you give. So my advice would be, if you're giving as a couple, do everything in both names. That way, even though one of you might have your favorite charity over here, if you've given 2,000 over here and your spouse is only giving 400, guess what you're limited to? 1,400. Put it in both names, no problem. You get the full 2,000. So tell them to start putting both names on the charity donations. Okay. You want the receipts to show that both names. You want to be able to maximize the $2,000 contribution. And again, where is this going on the 1040? I have no idea, but I'm sure we'll be told and we'll have it. The software companies will figure it out. Just be aware that that's an extra deduction that we can take this year. Okay. Now, there will be a new limit for people that do itemize. You know, Roger was talking earlier about how we have a lot of these wonderful widow ladies that will go ahead and give tremendous amounts of money to charities. I mean, I've got two of them right now that every year they max out to 60%. I think one of them we're carrying over $500,000 in charitable deductions that we can't take because they were more than the 60%. So, I mean, I have one that routinely, she will go ahead and usually donate 100% of her income every year. What does she live on? She lives on Roth. She lives on muni bonds, and she lives, which are non-taxable, and she lives on Social Security. But, you know, God bless her. She can give 100% of her income back to charities and religious organizations. I think it's great. All right. So there will be a new limit. Your program will go ahead and incorporate this for you. For people that do itemize, there's going to be a new deductible equaling 0.5% of your AGI without including any NOLs. So, you know, if you've got, let's just throw out the figure 100,000, 0.5% would be what, $500? So, you know, it's not going to be a big deductible for people, but just be aware of the fact that your program's now going to start throwing in a deductible, just like it does for medical. It'll start throwing in a deductible for people that give charity donations and itemized deductions. Okay. And are we at the end of this slide? Let's see what we got. Go back one, Jan. This is a good place to stop. So we'll go ahead and stop here, and we'll see everybody tomorrow morning. We'll start at 8 o'clock. Remember, day 3 is the one that changes. On day 3, we don't get started till 8:20 in the morning. That's a Friday, so I figure you need a little extra time to come in the morning on Friday, and we're getting out of here by 2:30, or you can leave by 2:30 on the third day on Friday, so you won't get into the afternoon. So remember, Friday is a short day for us. Tomorrow we got another Friday though. Go from 8 in the morning till 5 tomorrow afternoon. Huh? Yeah.